Hello everyone, welcome to the session on markets after the moratorium. In my earlier videos, you would have learned GDP could potentially contract by 50 lakh crore rupees. And even if government invests 10 lakh crore rupees, there could still be a potential contraction of 20 lakh crore rupees, equivalent to 10% of the GDP fall. What's the priority of the government? Current environment is not conducive. Fear of COVID is keeping people indoors. No dining, no huddling, no travel. Socialization is a taboo. What's the need to buy clothes, jewelleries, car, home furnishings? These are the last things in the mind. We are a socialist country. Government investments will have a social bias. They will be directed towards migrant workers through direct transfer of cash, poorer sections of the society towards development of the rural economy. This will pull the demand for products like gas stove, bicycle, biscuits, farm and rural equipments. There are twin challenges before the government. One, fall in consumption. Second, a structural shift of demand towards rural sector economy, which means low-cost, non-discretionary spend will be given a push. Rural sector dependent industries will see a growth of maybe 10 to 20%. On the other side, urban sector dependent products and industries could see a potential contraction of 40%. This would result in supply-demand imbalances. Profitability of industry will be at risk. Investments will be deferred, cost cutting and manpower reduction would be the norm. Government's timely action of providing moratorium has given a relief to the industry. But once the moratorium is lifted, there could be liquidity pressures on the companies. Issue of bonds by the government to raise finances, interest and principal payments to the banks, payments of statutory dues to the government. These are some of the things which will suck liquidity from the system. Fear of defaults will add further asset liability management challenges to the banks, which would also suck liquidity out of the system. Government would need to extend more support to the industry by bringing down the cost of capital. Banks also need to rise to the occasion by supporting the industry in easy restructuring of loans. RBI has already reduced the G-Sec 10-year bond yields by almost 1% in the last 3 months. We could further see a reduction of yields by 1% in the next 3 to 6 months. This would translate into annualized 40% return on G-Sec bond yields. This is one of the safest investments. Demand destruction has forced the industries to take various strategic measures to reduce the erosion of profits. Strategic measures like supply and service contract renegotiation, reduction of rentals, reduction of advertisement and promotion expenses, and various other measures of cost reduction and rationalization across the value chain. Despite the various strategic measures of cost reduction, industry will continue to struggle with profitability and liquidity, though at a much lower scale had they not taken any actions to stop the erosion of profit. Companies with strong balance sheets will perform better, whereas companies with high financial and operating leverage, very high debt positions and low cash surplus position will have difficult times. They might default and may be lucky to get the restructuring of the loans, while some of the companies will not be lucky enough to get the restructuring of the loans. Industry will witness a phase of restructuring characterized by consolidations, mergers and acquisitions, exit from non-profitable, non-core segments, divestitures. These will be the norms in the next 6 to 18 months. Once the moratorium is lifted, which is planned by end of August, we could see downward correction in the stock prices, timed with the declaration of Q1 results. This will be the time to differentiate the winners from the losers. So next 3 months could be difficult for the stock market. I would advise investors to be cautious with their investments in the next 3 to 6 months and stay away from the market. If they want to invest, they should invest only in strong companies with strong balance sheets and low debt positions, and that too with an investment horizon of more than 2 years. Stay tuned for more interesting sessions on strategy, economics, and business. If you like the session, press the like, share, and subscribe button. See you for the next session. Bye.